I am not a financial advisor, and this podcast is for informational and educational purposes only. The content discussed here is not intended as financial, investment, tax, or legal advice. Always consult with a qualified professional before making any financial decisions. Past performance is not indicative of future results. All opinions expressed are my own. Aloha and welcome back to the week that was. I am your host, Colin Edsman, and this is The Desk. And if you are just pulling up a chair, we do this every Friday. We cut through the noise and we tell you what actually mattered this week. No hot takes for the sake of hot takes, just what moved, why it moved, and what we're doing about it. All right, so let's take a look. Let's check our audio. Let's check our video. Let's check our content. All right, looks like we're up and running. As you can see, I'm being graced with the presence of a couple of very famous friends. This is Bluey and Bingo. They will be attending my son's birthday party tomorrow, so they're going to hang out here in the studio as I talk to you. Now, look, this was a weird week. Markets were closed for the 4th, so technically this was a 4-day trading week. But don't let the short week fool you. We had jobs report, we had the semiconductor sector taking another leg lower, we had one of the biggest media companies in America splitting itself in two, and we had Fed chair basically saying to Wall Street, stop looking at me for answers. That's the full week crammed into 4 days. Quick gut check before we dive in. Drop in the chat, are you more worried about the chip stock route or more excited about where the AI trade goes from here? I want to see where the room's head is at because it's genuinely split right now, and I'll show you why. Here's a quick rundown of the show. We're going to go through the top 3 stories that mattered, the market movers, the deeper angle on why and what's really going on under the hood. Then we're going to pull back the curtain on the Kairos trading desk for our live AI trading system for the weekly portfolio update. Then close with what we're bullish on heading into next week. Let's get into it. For our first story, the job reports came in a bit soft, but the market liked it. Thursday moved up a day because of the holiday. We got June jobs report. Non-farm payrolls just had 57,000 jobs, way below the 115,000 economists were expecting. Unemployment actually ticked down to 4.2% from 4.3%, which sounds contradictory until you realize the labor force participation math is doing some of that work. And the revisions were ugly. April got knocked down 31,000. May got knocked down 43,000. 74,000 fewer jobs than we thought existed a month ago. A self-jobs print used to be scary. Right now, the market's reading it as the Fed doesn't need to worry about an overheating job market. And that pulled the rate hike odds down. Per the CME Fed Watch tool, odds of the September hike dropped about 51% from 63% pre-report. The year-end hike odds fell to 76% from 83%. No weak jobs data in this environment is bond-friendly and mildly stock-friendly. Here's some takeaways. Job wage growth is only running 3.5% year over year against 4.2% inflation. So real wages are still underwater. That's the thing to watch. A soft labor market that also can't keep up with the prices is not a healthy setup no matter how the futures want to price that trade today. Okay, for our next story. Fed Chair Kevin Walsh says, don't look at me. Same day as the jobs report, Fed Chair Walsh, I keep saying Walsh, it's Warsh. I'll figure it out, huh? But Warsh just sounds weird. I can't get with it yet. Warsh was out there basically declining to give Wall Street any forward guidance. His message, watch the data, not the podium. He's not committing to a rate path. He's said this is more than once. He said this more than once, since taking the chair. The real regime change from how the Fed has operated for the better part of 2 decades. Forward guidance was the tool the Fed telling you what it's going to do, so markets could front run it, and volatility stayed low. Warsh ripping that away means every single data point, jobs, PCE, CPI, now carries more weight because it's the only signal you're going to get. That's structurally more volatile, meeting by meeting, print by print. Here's a takeaway. Get used to bigger swings around data releases. This isn't a 1 week story. This is the operating environment for the back half of 2026. All right. Warsh is just a super weird name. Before I get into my next story, it's going to take me a second to get Warsh's name down. It's Warsh. What is that? Ugh, doesn't matter. We aren't going to be looking at him for a lot of answers anyway. For our next story, Comcast splits itself in two. Monday, Comcast announced it's splitting off UBC Universal and Sky into a separate publicly traded company, tax-free, expected to close roughly mid-2027. What's left of Comcast becomes the cable/connectivity business. UBC Universal, NBC, Peacock, Universal Pictures, the theme parks, and Sky in Europe becomes its own standalone media company. Mike Cavanaugh, currently co-CEO, takes over as CEO for the new UBC Universal. Michael Angelakis, the former CFO, becomes CEO of the slimmed down Comcast. Stock popped 6% on the news. Why this matters though? This is the old media conglomerate model finally admitting defeat. Bundling cable pipes with studios made sense in 1996. It doesn't make sense in 2026 when streaming, cord cutting, and content economics are completely different animals. This is the biggest domino yet in the unbundling of media story, and it's likely won't be the last one this year. Here's a takeaway. Watch for this to pressure other legacy/telecom names to explain why they shouldn't also split. That conversation is coming for more boardrooms, excuse me. Thinking Broadcom over here. All right, chat. Which one of these three is the one you think we're still talking about in 6 months? My money's on Fed guidance shift. That's the one that's changing how everybody has to trade, not just one sector. All right, let's get into some market movers from this short week. Let's run the tape. Indexes for the week, Dow actually led, touching a fresh intraday record of 52,742 before closing Thursday at 52,900, up about 1.1% on the day. The S&P 500 closed basically flat at 7483. Nasdaq was the laggard, closing at 25,833, down close to 1% on Thursday, alone as tech and chips dragged. Classic rotation week, money moving out of growth/tech into the boring cyclical names. The Chip Wreck, Part 2. This was a story under the story. The semiconductor sell-off that started with Broadcom's cautious guidance back in June 4th, which alone took Broadcom down 14% in a day, is still going. This week, the VanEck Semiconductor EPF ticker SMH dropped another 4.5%. KLA fell 11%. Micron, which is still up in absurd 260% on the year, dove more than 10% in a single session on memory pricing worries. Nvidia even pulled back 1.4%, and this isn't a US story. Samsung Electronics dropped over 7%, SK Hynix sank more than 9%, Asia's two biggest memory chip makers getting hammered as the sell-off went global. All told, this chip rout has now wiped out somewhere in the neighborhood of 1.3 to a measly 1.4 trillion in the sector market cap since June. All right, here's some of the winners though. Rocket Lab up about 15% on the news it's acquiring satellite operator Iridium, which itself jumped 25% on the deal. Satellite and space consolidation is very much live themed post SpaceX IPO. Google nearly up 5% in a day. It was announced that it's joining Dow Jones Industrial Average, replacing Verizon. Comcast up 6% on the spin-off news that we already covered. Now, here are the losers. The entire chip complex, as I stated above, and OpenAI. Now, this isn't public, but the AI trade broadly wobbled on the reports that it may push its IPO from 2026 to 2027. Sam Altman reportedly wants a $1 trillion valuation and isn't willing to compromise on price for speed. And with SpaceX's post-IPO stock action getting choppy, the bankers are telling him retail appetite might not be there quite yet for a media cap tech debut. One more to watch, though. SpaceX, right? Still trading, still enormous, still the biggest IPO in Wall Street history back on June 12th. At a 1.77 trillion implied valuation. It's cooled off from that first day pop and it's been choppy since. We're tracking a few of the proxy plays around on my Kairos AI trading desk, but more on that in just a moment. VIX is sitting around 16.5 to 17, calm on the surface, but with this much sector level violence happening underneath, I wouldn't call it complacent. It's a market that's rotating hard, but not panicking. Okay, let's get into the deeper angle. Zoom out with me for a second. Here's what I think is actually happening underneath all of these headlines. We spent the first half of 2026 in an AI and megacap tech supercycle. SpaceX going public at a damn near $2 trillion. OpenAI and Anthropic both lining up IPOs. Chip stocks running to the moon. Micron up 260% year to date, even after this pullback. That was a believe the story, don't ask a whole lot of questions kind of market. What we're watching now is the show me phase kicking in. Broadcom's guidance in early June was the first crack. The market said, okay, but are the AI capex numbers actually going to show up in earnings? Or are we just trading on vibes? And every data point since has been market testing that question. Chip stocks getting a hit again this week. OpenAI's bankers getting nervous about IPO timing because SpaceX's own stock has been shaky since its debut. That's not one bad week, that's capital starting to demand proof, not promise. Meanwhile, look at what's actually working. Comcast unbundling into a cleaner structure, Rocket Lab and Iridium consolidating its satellites, Alphabet, a name that's diversified well beyond just the AI bet, joining the Dow. Insurance industrials, financials quietly doing fine while the flashy AI trade catches its breath. That's rotation, not collapse. Money isn't leaving the building, it's moving into a different room. And when you've got the Fed adding a second layer to all of this, Warsh refusing to hold anybody's hand, so now you've got a market that's repricing the AI trade and losing forward guidance security blanket at the same time. That's a recipe for exactly what we're seeing. Choppy, headline-driven, sector rotation heavy trading instead of one smooth line up and to the right. Here's my overall look on this. It isn't the end of the AI story. It's the market growing up and demanding the story actually cash a check. The names that survive this phase with real revenue and real margins are going to come out on the other side a lot stronger. The ones running on the story alone are going to keep getting its, shit kicked in. Life angle for a second, because that's part of what we're doing here, right? This is the same lesson in the markets as in anything else you're building, a business, a portfolio, a legacy. Hype gets you attention. Proof gets you longevity. Doesn't matter if it's a $1 trillion IPO or a $50 position in your own account. Eventually somebody asks, show me the receipts, and you'll want to be ready when they do. Now, before we get into the AI section and how my agents on the Kairos trading desk are doing, we are going to take a quick moment. I will be right back in just 1 minute. Stick around and we're going to talk about how Kairos, the AI trading desk, did, and all the agents. Talking to nobody. All right, so we're gonna go back to that because I was talking to literally no one. I was on pause. My goodness. Now, thank you for sticking with me. If you stuck with me and you're staring at my face blankly, say nothing there for. Oh, thank you. I got it. All right. So I got a check from my studio lead, and they're telling me I wasn't talking either. So here we go. Now, we're going to be talking about the Kairos Trading Desk, the AI agent run trading system with live capital, real fills, and I'll show you everything from wins to mistakes. The account is sitting up from where we started, currently up 5.29%, which is not bad. It was up a little bit over 1% from last week. That's not bad for 3 trading weeks. The trades this week, the desk made 8 moves, 5 closed, 3 opened, and still running. 3 went, 3 winners, 2 losers on closed trades. That's a 60% win rate for the week. Now, ticker IQVA was a star of the week. Uh, the agents entered at 189.37, hitting the 8% profit target and got out at 204.40. That's about 15. That's about no, excuse me, not 15. That's about 7.94%. It's a clean, disciplined, exactly how the system is supposed to work. Now, Bank of America, I had to force it to kick out of that portfolio because it held it for 13 days. It got in at a little less than 56 bucks, got out at 57.27. So it was up about 3%. It's a good exit. It was up, right? Profitable. Now, next, it held Morgan Stanley, quick in and out. The Kijun trend breach exit 2 days later for a 50-cent profit, basically scratch, but it followed the rules that I set. Now, on the downside, we got stopped out of our target position on consumer discretionary weakness. So we took about a 5% hit on that, which is the stop that the agents put in. Now, the next position that took a small hit was the ticker CNXT, or China Next Investors Innovators ETF. That one stung a bit because it gapped down on China internet sector sell-off, blew right through our stop, and I took a 7, almost 8% on that, and that was the biggest loser on the week. Honestly, that one hurt a little bit, just because it just honestly overnight popped right through the stop. So I mean, you can't fix that. That's just like you going to bed and you waking up the next morning and you're like, oh shoot, well, too late. It happens, right? But the system's still in place, as we talked about with the other trades. So we took a little bit of a realized loss on the week, but there are a lot of unrealized gains sitting in our portfolio right now that we've added the ability to start trading options. So it's a lot better than just the one number suggests. So here are the things we're holding right now. Ticker KIE, which is a S&P insurance ETF. It's sitting at about 5% unrealized. It's getting close to our 8% target of 65.48. That one's been quietly awesome, actually, which is kind of cool. So the next one is Southern Company, or ticker SO. It's a utilities play. It's got in at 97.19, holding just above the Ichimoku cloud with a small margin, let's say 0.78%. So we're watching that one closely. It might pop through the stop over the weekend, but we'll have to see. The next one is the EWT, ticker EWT, which is the Taiwan ETF. It's got heavy Taiwan Super Micro Oh no, excuse me, TSMC, yeah, exposure. So this one's just breached its trend following stop level on the Kijun line on Thursday's close. Now I'm not going to pretend like I know what the Ichimoku indicators mean, but this is the most token frugal indicator that I've found that functions for the agents. So it follows it. I'm happy to, well, let it go. Now we have the final number for you on this position next week, but the position was running about down about 2.7% unrealized when the breach hit. Then we got, but there's also options now. So we have a put, $93 put on as a hedge that we place against our Southern, our ticker SO position. It hit its stop Thursday too, down about 50% the premium. That's close to and that's close to also queued on, for Monday morning. That hedge did what hedges do. It cost us a little bit of money while the stock held up fine, but it's supposed to be insurance, right? That's the price of insurance. And it also bought its first SPY call. It bought the 755 call, our one high conviction directional options play for the week. And it's the best performer on out of the portfolio, up 23%, hitting some pretty decent sized gains. One real story from the week. No sugarcoating on this one though. 2 Fridays ago, the system chased a re-entry of ticker LBL, LABU. I don't even remember it because it pissed me off a little bit. It was a leveraged biotech ETF, right back into a position that it just exited, and it cost us a little bit on basically the same day. That's the rule violation system that it flagged, and I had to input a rule after that you don't go back into a position that we just held for at least a certain amount of time, and we don't go back into it unless it's below what we made, right? So it made this decision before I caught it, and we had to exit for a bit of a loss. But that's okay. That's okay. It's a small dollar amount, but it's exactly the kind of mistake that we want to be catching and logging. I don't want it to be buried in any way. That's why we run this thing kind of in the open. On the fun side, we got a couple of different sleeves, right? So there's NAV. The NAV on that sleeve is actually up 1.3%. June 18th, the second sleeve, which is a separate capital. It's the same. It's all the same capital, right? It's all. I'm just giving it different parameters to see how this would work on a much bigger scale. Because I want to eventually create something that everybody in the world can copy and utilize for themselves, and it would just run for them, maybe, right? Or at least the framework, right? How you want it to trade, it's up to you, but the overall framework should be out for everybody to use. But I want it to work, right? I want this to run for 6 months, maybe longer, until I start to really tell people how it functions on the deep inside. Now, if you're looking for someone who can help you get your agent running and your agent connected, yeah, I'm here for that, right? I'm not going to tell you what story to give it, but I can tell you how to get it talking to your account, talking to your agent runner. Or I use Claude, right? I'm using Claude for a lot of things nowadays because it's giving me time back to my family, right? And that's all we got to do. We're trying to work a little bit and then have things automate so we can spend time doing the things we love in life. It's more than just charts out there. But the number one, the number I want you to watch with us is the all-time high win rate. Since going live, it's about 42.9%, 6 wins out of 14 closed trades. Our target is 62%. That's more than the 5-point trigger for the built-in checkpoint rule. And if the win rate is still lagging like this at our 4-week review next Friday, which is July 10th, the system is designed to automatically cut some position sizing by about 30%. I'm telling you that now, not after it happens. That's the whole point of building guardrails. You don't get to ignore them just because you don't like what they say, right? We're trying to create an emotionless trading system, and it has guardrails. The guardrails are not my piddly emotions. The guardrails are set, it's following a system. I sit back and I let that system function, and I check the data points. I add a couple things here and there, take out a couple things. Now, this is an automated trading system. It's not a person, right? But it's doing what it's supposed to be doing. And that's what I'm really appreciating about this. Next week, we're going to be watching Monday morning. We're going to need to confirm the two fills at open, the ticker EWT exit and the ticker SO put close. KEI is knocking on the door of its profit target, and July 10th is the big one, the 4-week checkpoint on the whole system, where win rate, drawdown, and sizing all get a hard look. FOMC minutes drop July 8th too, which could move the whole board. Like I said, Fed speeches, meetings, all that's going to move the market a lot more than before because, well, he's not the guy. He doesn't have the answers, he said. Fed Chair Warsh. Is Warsh just sounding weird coming out of my mouth, or is it just a weird name? Leave me a comment in the chat. The dashboard, on the other hand, is something we're going to keep following over the next who knows how long. Honestly, this could go on into perpetuity because agentic trading is, well, bullish. Now, on that bullish outlook, let's end the analysis on the offense, not defense. Where's the opportunity heading into next week? So we're looking at rotation, not retreat, where we've talked about this before. Everything we just walked through, the chip sell-off, the Fed pulling away, the security blanket, AI, now OpenAI slow playing its IPO, reads scary in headlines. But underneath it, cyclicals and boring sectors are quietly working. Insurance, industrials, select, and financials. If you've been all in on the AI trade and haven't looked at rotating some chips into some stuff that actually, well, have been grinding higher right now, this is the week to start that conversation with yourself. The Comcast unbundling theme has some legs. When one major media/telecom name splits, the market starts pricing in who's next, keeping an eye on other conglomerate structures over the next few months. There could be real value unlocked in whoever moves next, and you want to be watching before it's announced, not after. Semis will snap back. The question is when, not if. The sector doesn't lose 1.3 to 1.4 trillion in value and it just disappears. Names like Micron are still holding up at 260% on the year after a brutal couple weeks. When this rotation runs its course and the show me phase gets some actual proof points from AI capex spend translating into real value, the quantity names in the space are going to be the ones that lead back up. Patience over panic. Space and satellites are a real theme right now, not a novelty. SpaceX going public, Rocket Lab buying Iridium. This sector just got a massive amount of public market attention and consolidation capital in the span of 3 weeks. Worth building a watch list here, even if you're not ready to deploy quite yet. Next week's calendar, we got FOMC minutes Tuesday, a lighter data week otherwise, and our own 4-week checkpoint on the Kairos trading desk coming on Friday. So set your alerts. That's the week that was. And thank you, Bluey and Bingo, my son's friends, for joining me on the show with you. Tomorrow is his birthday party as well as America's birthday party. So every year my son's going to be getting fireworks for his birthday, and that is incredibly exciting. So don't expect me to be around at all this weekend. I'm going to be hanging out with the family. So we got soft jobs, a Fed that's done holding your hand, a media giant breaking itself apart, and chip sector that's still working through its hangover, all crammed into 4 trading days. Here's what I want you to walk away with. None of this is a reason to panic, and none of it is a reason to get complacent either. Markets rotate, guardrails matter. We showed you ours today, and warts and all, Laboo mistake included. Real discipline isn't pretending you never miss, it's catching it, logging it, and letting it be the system and letting it correct itself. If you aren't writing it down or trying to log any of this, you're just fooling around. So, chat, drop one question for that you've got for next week. I'll pull a few and answer live before we go dark. And if you haven't already, hit follow, turn on notifications, and pull up the dashboard. It updates in real time. I'm gonna try to get it in a place where people can see it, right? So look forward to that. You don't have to wait till Friday, and you just keep watching the markets. This week we also had the World is Flat event by Robinhood in London, so please check that out. I was live watching that the other day. But this was the week that was. I'm your host, Colin Edsman. We will see you sometime next week. As always, farewell, a hui ho. Please be safe. Take care of your mental health. And I'll see you on the porch, as well as in the markets. I love you. Peace.